Hello, everyone. Yeah, just getting set up for the webinar now. Terrible webcam. Hopefully, you guys can hear me clearly. Please just hit me in the hit me in the chat. You've got the chat window. You've got the Q&A. I'm going to try and answer them as I go through as well. I just want to share the presentation with you guys. We can get started while everyone joins up. Yeah, please let me know if you can hear me clearly. If you can't, it's a problem, and I will find out how we can fix it. But cool. So you should now be able to see the presentation screen. So if you can't, again, please let me know. If it's unclear, please let me know as well, and I'll try and switch on to a different microphone. I'm trying to make it a bit lower. Otherwise, you guys are going to be looking at me looking down all day. Cool. Right, so, okay, let's get started. Okay, so we've got, I think, most people on the call already. Yeah, so today we're going to do the June monthly review. And I do this every month. It's pretty much just a rundown of the portfolio, what's happening in the news at the moment, how we're thinking about markets, mainly internationally. So this doesn't really cover our local portfolios. It's very much focused on the international portfolio that I run. We chat about kind of big company news, what's affecting the stocks that sit inside the portfolio. The whole meeting's kind of designed for people that are already invested in the portfolio, just to keep a tab on what's going on. But it's also, you know, if you're managing money yourself, and you kind of just want to get a sense of how we're thinking about the markets, or if you're sitting on our online trading or a stockbroking desk, or even an advisory desk, and you just want to kind of get a sense of how we're seeing markets to make your own decisions, that's what this webinar is for. Yeah, so before we start, in case you guys are new, I'm just going to run through the two slides that we normally do it. Who are we and why should you listen to us? Okay, we were ranked South Africa's top stockbroker in 2019. We also ranked the top advice broker. Last year we were ranked top online broker and we had the top tax-free savings account. We came second to Standard Bank overall in the rankings. We're currently competing, so the awards should open again in about a week's time. So if you are a client, we're going to obviously send you those mailers. Please go fill them in for us, because it makes a huge difference to us just to, and fill them in honestly. I mean, we want to know where we sit. We want to understand, what we're good at, what we're bad at, so we can work on what we're bad at and offer you guys more of what we're good at. So it's a fantastic awards process. Intellidex runs it. They vet us, like they grill us. They do mystery shopping exercises. I've got to go through all the risk systems of our portfolios and our execution systems and our platforms for them. And then obviously they ask you guys to fill in that survey as well, so they get a sense of how if the clients are happy, if clients are sad, and that's kind of how they do the overall rankings. Normally it's kind of the domain of the big banks. It's been PSG, ABSA, Nedbank. These are the kind of people that we're competing against. Obviously, Ransford is much smaller, and we were very happy to have been awarded that 2 years ago. But it doesn't mean we can't do it again. So we're going to definitely try this year. So please help us out. What do we do? If you're not aware, we run the business across a couple of different verticals, if you want to put it that way. We do online trading, which is we give you systems. That's what we won the best online broker for. We give you the technology and the systems. You do everything yourself. If you need passwords reset, that kind of stuff will obviously still be available to you. But really, you making your own decisions. We cut your costs to the absolute minimum. And we do still send you research and all that, but it's basically you don't speak to someone directly. If you do want to speak to someone directly and you want someone to advise on the portfolio, that's what we've got private broking for. You come through, you want to know if MTN is better than Vodacom, you chat to your dealer. Obviously, the minimums are a little bit higher there because we have to justify those salaries as well. So we can't give you good quality advice for free like we can. Obviously, online trading will always be a little bit cheaper if you don't require the service. Managed portfolios, that's what we're talking about today. That's We've just hit our 5-year track record on the global managed portfolio, which is quite exciting. So I'll take you through some portfolio statistics and how we've done it, what we've done, and kind of some of the company. I always try and put in one stock pick as well, so that you've got something to go away with. So we're going to look at one of the companies that we hold and one of the companies we prefer. We're also going to look at one of the companies we're concerned about. We're going to chat about what's wrong, and if we should be concerned, if we should be looking at an exit. Structured products. We've actually got a structured product that's closing today. That's why you'll see I have bags under my eyes and I haven't slept because we are just finalizing basic implementations on one of our structured products. And I'll take you quickly through it if you guys are still interested. Offshore transfers, that kind of sticks the whole business together because obviously we work so much internationally that we want to try and make sure that you guys have access to low-cost offshore transfers. Yaku taking care of wealth management for if you don't know what you're doing and you don't understand your risk, you just are completely lost, or you're going through a complex transition, you're moving into retirement, you're converting your retirement duties to living annuities. Speak to a wealth manager. They can often save you a lot of costs and they'll get your tactical asset allocation right. And then tax-free savings accounts, we won an award. So we're busy reworking that. We've always offered free tax-free savings accounts to our clients so long as you have a second product. And yeah, this year we're going to launch kind of a managed version of the tax-free savings account because the problem that we're finding is clients go in, they kind of struggle to make the decisions themselves because they get onto the system and then they go, but what must I buy? So we're going to offer you guys a fully managed product, but that will also probably be launching in the next 2-3 weeks. We've got all the weightings, all the kind of groundwork has been done for it. It's just a matter of rolling it out from a marketing point of view. So that's us. That's what we do. So without further introduction, let's get into what's going on for the month. Okay, I'm going to go through global markets, commodities, currencies, and then we'll look at like some of the stocks in the managed portfolio as well. Market overview. Very different picture. Very, very different picture to what we had last month. Last month, if you remember, South Africa was one of the best performing markets on the planet. I benchmark, well, I don't benchmark, at least I measure this all in, we rebase to 100. So this is all measured in US dollars. So you don't have any currency effects in this. Or you do or you don't, depends on how you want to understand that statement. But essentially everything is reduced back to dollars so that you're basically comparing apples with apples. There's no point in saying, oh, the US went up 2% and South Africa went up 10%, but South Africa, you're measuring it in rand and the US you're measuring in dollars. So we just reduce everything back to dollars. And a very different picture. If you look at what happened in June, so these numbers run kind of, from today backwards. So I actually ran them last night. So it'll be from last night all the way back exactly 1 month. You can see it's been a very, very difficult month for portfolio, just for markets in general. We had the US up 3%, and that was the shining light in the global economy. We saw everyone else under pressure. So we saw a little bit of nerves coming into June. So what do they say? Maybe it's panning out, the old market saying, sell in May and go away. If you had sold in May, you would probably be able to buy a little bit cheaper unless you sold US stocks. South Africa heavily under pressure. So we were up around 8% in May. We've unwound a lot of that as kind of, I think the commodity prices have started to moderate and people have looked a little bit more towards developed markets. Interestingly, China's still under pressure. So we're going to look at the 1-year chart in a second, but China down another 4.68%. So China this year has been in a world of hurt. It's just been a mess all over the place for China. So let's go have a look at the 1-year numbers, and you can see. So the little green line on the left-hand side, that's the South African market over the last year. Now, obviously, you're going to start seeing these numbers moderating because if you think back to about a year ago, we were starting to come out of those lows of the coronavirus collapse. If you look at what we were chatting about last month or the month before, there we were right at the peak of the panic that we saw, when we first got those global lockdowns. That's when the markets, basically crashed, 2008 style. Everything went to hell. that's where we're measuring from. So of course we've had this big rebound, and if you had bought right in the lows, you would have had these incredible returns. Even now, if you had bought into the South African market or the Canadian market a year ago, you'd be sitting on 41, 43% returns. Now obviously this is going to moderate over time. So as markets get back to normal, you're going to see more reasonable numbers. Remember that the US on average over a 1 year period, the US market should do about 8.5%. That's the S&P 500's long-term average. That's what you can expect in dollar terms. If you're just investing in an S&P 500 tracker, that's what you want. So 40% is unusual. That's not what you expect from the US markets. It's just because of the base effects, of the collapse. Looking at China, though, the reason we're looking at this graph and the reason that you're trying to, the reason that we're measuring it, we're just looking at how are different economies coming out of the pandemic. And we look at one, and we get a lot of criticism. I get a lot of criticism on Twitter. I don't know why, because I posted it the other day. I said, "Oh, look how good South Africa's doing." Last month we were one of the best performing markets, as you can see, over the last year. And everyone was really upset that I was only using a 1 year view, because I think people are so pessimistic about South Africa. Now, the point is that we've got to pick some sort of time frame. I can do 6 months, 3 months, 1 year, 5 year, but then we'll spend the whole presentation going through different charts. So we've got to pick something. So I do normally a short one, which is a month, and a long one, which is a year, which just gives us a sense of like a pulse of the market. What's going on? How is it moving? And we can see now over the last year, China has had a nightmare. That's really been over the last 6 months. So we saw that their recovery kind of peaked at the end of January. They have the orange line on the left-hand side. And that coming all the way down. Over the last year, China almost delivered, like Chinese markets balanced back to dollars, basically flat. No movement in Chinese markets, and they've been under incredible pressure over the last year. So normally now I go and look at the underlying market that we kind of most interested in, which is the US, and we'll find out a little bit later in the presentation why we're so interested in the US. But yeah, what is going on in China? So, WTF in China? Are ADRs still safe? So that's the question that we kind of were asking, because it's something that came up in our investment committee. I mean, we've obviously got a chat group that we, all the guys on the desk go through. And as soon as we saw the DD listing and what happened there, and I'm going to go through the story in a sec, immediately the messages are coming. Are we still happy with Alibaba? That's the big question, because it's the only ADR. ADR is an American depository receipt, and it basically gives you a way of investing in Chinese companies, but sitting in the US regulatory environment. So instead of sitting, in Hong Kong directly, which we can do on our platforms, but we've chosen to go the US route just because we wanted that kind of additional exchange protection around client assets. But the question now is with this DD listing, are they still safe? That's what I want to kind of understand. So what happened with DD, and who is DD, and why do we care about this? So if you don't know who DD is, it's basically the Chinese Uber. So DD, it's a ride-hailing company, and what they've done over the last month is they listed in the US. They've listed ADRs. Now, as they listed, I mean, obviously it was a fantastic listing. They raised a whole bunch of money. It was really exciting. And immediately, it was about a week later, China just cracked down heavily. They cited, we don't have all the details of why they're after DD, but they cited data security as an issue. And they made US companies like Apple remove DD from the App Store. So you basically can't use DD anymore if you have an Apple phone. Now, what that did is obviously the stock's just listed. It's just gone public. There was all this froth in it. And everyone was really excited about being able to access this really exciting economy like China. And the stock obviously collapsed. Now the real worry, and the worry that I think has brought Chinese markets down from around February, is just the heavy-handed way the Chinese regulators are going after their big multinational companies. So we've seen it with Alibaba, obviously with the disappearance of Jack Ma. We own Alibaba. It was a concern. The stock has come off a little bit. They obviously levied a big antitrust fine on Alibaba. Very different from what's going on at DD. DD is a security concern. Alibaba was an antitrust. It was just too big. The government was unhappy about comments that Jack Ma had made. Now, what happened with Didi is the government in China is obviously also just unhappy. So what they did is apparently it was a report that surfaced where over like the hotter months in Beijing, there was a report of actual Chinese officials using Didi cars and where they were going and what they were doing. And obviously, you know, the Chinese authorities didn't like this. They didn't like the level of privacy, or at least the privacy breach of their officials, and they kind of woke up to the fact that these companies that hold a huge amount of data could be a significant security risk around them, and it could be a potential embarrassment for the Chinese Communist Party. So obviously they lashed out, same way they did with Alibaba, and same way they're doing with Tencent. So you would have seen in the last month on the local exchange, Naspers and Prosus also down on one day, they were down around 6%. This was because the regulator was again getting involved. That specific incident was it was called the CAC, and they were looking at basically Tencent, who's got they've got WeChat and a lot of gaming assets in China. They were looking at merging two websites. So it was the number 1 and number 2 Chinese game streaming websites, and the regulator blocked it. And obviously, that kind of action from regulators just makes markets very, very nervous. So should you sell your ADRs? Are they not safe? Now, there's a couple of things. Kind of the prevailing opinion at the moment is that we're seeing a lot of things saying that you shouldn't be invested in China through ADRs or in any other way because Chinese regulators can't be trusted. There's also this kind of idea in the market at the moment that Beijing has no interest in its stock market performance. If the stock markets are doing badly, Beijing doesn't care at all as long as they have control of the markets. They're almost above what happens on floating stock markets. Is this true? Isn't it true? It's very difficult to say. Now, if you look at it, there's also another theory in the market that the Chinese government is moving more towards manufacturing concerns and away from these big software technology companies. So that's kind of if you just kind of do a brief Google search, that's what you kind of get a sense is going on. Now, from our sense, I don't think this is the case. You look at it, the Chinese government has often been very, very sensitive historically, and I actually forgot to put the chart up for you guys now. But the Chinese government has been very, very sensitive to stock markets that have collapsed. When the Chinese stock market collapses compared to Western economies, often the Chinese government gets involved to deliberately prop up their market. There's been cases where they've actually gone on propaganda campaigns to tell the Chinese public to go and buy shares directly in the market in order to boost share prices. It's a very, very manipulated economy and a very manipulated financial market. So from our point of view, the idea that the Chinese markets are a lot lower actually looks more like an opportunity to get into China. And I was kind of saying, will the Chinese intervene directly in their market if their market keeps falling? The Chinese authorities, while a lot of people say they don't care about their markets, when you're looking at it, and the US is essentially beating China by 40%, and China is down, is flat for the year, that does become an embarrassment for the at least for the government in a way. So we've already seen regulators. So just before I did the presentation, I saw it come through on my phone. China has just cut the what's called the RRR rate, which is basically like it's the reserve requirement rate. Now, what that does is it's essentially a form of stimulus that China is putting into its economy, and that should boost markets. It's boosted markets in the past. The last time they did this, I think, was in April 2020. As we went into coronavirus, there's been no additional stimulus coming through RRR cuts in China since then. And already we can see them starting to act. So for me, it kind of goes back to that market saying, things aren't, stocks are never popular and cheap at the same time. And there are lots of reasons. As you can see, crackdowns in China, Hong Kong, stocks falling. We've been very, very light on China for a reason, for a long time in the portfolio. Like I said, the only thing that we hold is Alibaba. Now, we're concerned about China in general. If you look at the Chinese demographic, the whole Chinese economy is changing. But in the long term, we're kind of a little bit more circumspect about China. We understand that like investing in China is a much, much riskier prospect than investing in Europe or UK or the US. The West has a lot more stringent regulatory framework than China. But On the other hand, with risk comes reward. A lot of the Chinese companies are a lot cheaper for what you get. Now, the reason they're cheaper is because you've got to deal with these regulators. And it's one of the things that has been in the market for a long time. Everyone knows investing in China is kind of a little bit hair-raising. So you do it small, and you do it normally in their larger cap companies. Because what do you gain from investing somewhere that's a little bit more risky like this? You gain access to an incredible population. Basically, you get companies that are able to operate behind the Great Chinese Firewall. If you look at kind of projections, they say that China is going to be a bigger economy than the US by about 2033. Again, all sorts of different projections from different people. Many people say that China will never eclipse the US, that the US is just going to start accelerating because of the fundamental problems with not having an open and entirely free society. There's kind of, it's a debate that Viv and I kind of have quite often, because he's quite pro the idea that in the modern world, when you have the level of control you can have through social media and the big tech companies, that kind of free market pricing. And the big problem with a centrally planned economy, like Russia in the Cold War, was that you don't have price discovery, and you don't allow the free market forces to accurately transmit pricing information between different industries. There is a conceivable future in which our software and our AIs are that complex and advanced that you could have a centrally planned economy that is being planned by our technology, essentially. Now, that's kind of a very, very interesting debate that me and Viv often have. We're nowhere near that yet, but it's something to think about. It's this idea that it didn't work under communist Russia in the 50s doesn't mean it won't work in a modern technological age where you have the internet and different pricing information. But that's kind of getting outside the scope of our discussion today. But are we concerned about ADRs? Yes, we are. Are we looking at Alibaba? Yes, we are concerned about the holding. We've currently got it on hold. We're not buying more Alibaba at the moment. But we're also not getting out of Chinese markets. I think that there's an opportunity to get into Chinese markets here. Obviously, we're keeping a very, very close eye on what's going on. But I think there's an opportunity. If you look at the history of Chinese markets, when you start getting the government involved directly in the stock market, you get these huge run-ups, like almost instantly. And it's happened a couple of times since 2000, where the Chinese market has kind of gone in a year and a half, 2 years, has gone on around a 200 to 300% run. And it's because the Chinese authorities just decide we want our stock market higher. You get propaganda campaigns, you get all sorts of crazy things happening, and stocks just go ballistic. So how are we getting access? So this is, like I said, we're closing a structure at the moment. Now you can go get direct access to it, via an Alibaba or Baidu or JD.com. Or you can even go and buy DD shares now that they've collapsed. Our preferred entry into the Chinese markets is actually through a little bit safer way because, like I said, it comes down to your risk profile as well. But this is the structure that Viv is closing this afternoon. If you are interested in it, there's still time to get in, believe it or not. You don't have to have your money in an account. Minimum is about 100,000 Rand. But we do need your applications, but we need at least a commitment that you're going to go in by this afternoon, and we probably need application forms by Monday latest. What the structure does is it offers you 30% capital protection. It offers you a digital coupon of 22% on the upside, links you to the emerging market, the MSCI USD MSCI emerging market index. At least the MSCI Emerging Market Index. You've got it there, MXEF. I've given you the geographic weighting. Almost 40% of this is China, but the other 60% is just general emerging markets, which have been under pressure. We're going to look at that in a bit as well. But yeah, so it's an interesting thing. I've put the payoff profile on the left-hand side. What it essentially does, if you went and bought an ETF that tracks this specific index, and you said, I'm going to go buy a nice Vanguard emerging market ETF, if the market ends 10% down after 4 years, guess what? You're going to end 10% down as well. If the market ends 10% up, you're going to end 10% up. It's a perfectly linear payoff profile. That's the gray dotted line there. If you end up 50% after 4 years, you get 50%. If you end down 50%, you're going to lose 50%. That's what the ETF is going to do for you. This is kind of an enhanced structured product. It's a credit note that goes into Barclays, so you are taking on Barclays credit risk to use it. But If the market ends 29% down, you get all your money back. So that's the kind of return profile there. So if you look at it, if you end, like let's say 25% lower, your actual return is going to be 0%, not negative 25%. On the same way, you get this little kicker on the upside. If you end 10% up, you're going to get 22% in dollars. If you end 12% up, you're still getting 22% in dollars. But if you end up 30%, you're getting 30% in dollars. So it's uncapped on the upside, but you've got these two areas here. I don't know if you can see my mouse, but you basically got two areas under here, which will guarantee you outperformance of the underlying ETF. We like it. Now, how can you give underperformance like that? Give guaranteed outperformance of an ETF like that? Like I said, we're taking on Barclays credit risk. Barclays, obviously a big international bank. You're actually taking on Barclays and investor credit risk. But again, it's a single product. So it's the risk is probably a little bit outside this discussion. But I mean, if you are interested, come chat to us afterwards. Come chat to me afterwards, and I'll kind of take you through it. But essentially, you're taking on bond risk instead of equity risk. So you're senior in terms of risk compared to an equity, but you've only got exposure to a single company, or in this case, two companies, Barclays and Investec. So don't go and stick all your money in this like an ETF. This is something that you do with about 5 to 10% of your money. And I'm pretty certain you're going to get at least 22% in dollars over 4 years or more. If we do go for like a 200 to 300% run on Chinese markets in the next little bit, like I said, uncapped upside, and you're going to participate in the full amount. There's liquidity on the product. So if this happens in year 3 and you want to get out, obviously we'll do the repricing and we can get you out for a profit ahead of time if there's a real run in Chinese markets. But I do like this. We are going into it. We're putting clients into it as well. It's a good product, in my opinion. For the right type, for the right person. But yeah, if you're interested, come chat to me afterwards. Okay, I'm gonna have to move along here. We're already halfway through. Okay, cool. So, and I'm talking fast as well. So what's happening in the US economy? Let's get back to like kind of the regular programming. That was just kind of a little side note on China. What's happening in the US at the moment? So we had, normally I do this before non-farm payrolls. So we've actually had the non-farm payroll numbers out. We've actually seen, it was an interesting number. So it kind of beat and missed at the same time. So it beat on the headline number, but it kind of missed on the unemployment rate. So you can see we kind of toddling along here on the US unemployment rate, 6% to 6.1% to 5.8%. We're now ticking slightly higher again. We're also seeing US inflation starting to really pick up. Remember, the Fed's got that 2% target rate. They are happy for inflation to go through the target band, but they've got an inflation targeting framework. They want inflation. They want goods and services increasing at about 2%. We're at 5%. Now, the Fed has been very, very vocal on this all being transitory. They're saying, listen, obviously there's been supply chain disruptions. Look at the lumber market. Look at the secondhand car market. You're going to get these big price spikes because we've had such a dramatic disruption with coronavirus that this will be transitory. We had FOMC minutes out this week on Wednesday. They kind of struck a slightly more hawkish tone. The idea that we're going to start to see a tapering of the Fed's asset purchase program, I think that's being worked into markets at the moment. I'm hoping that we're going to have a nice taper tantrum now and we're going to see markets coming off nicely. I've got cash to deploy and we're also launching a European and a UK portfolio. So if I can get 10, 15% down, that will be perfect. But obviously we're not counting on that. But longer term, the view is that the Fed is going to be supportive, and we do think that the Fed is right on the fact that this kind of current spike in inflation is transitory. Every Thursday, we do an investment committee meeting with everyone in the office, and this week what we did is we decided if you follow the Fed, you'll know that they do what's called the dot plot. So all the Fed officials go and say where they project interest rates over time, going into like 2021, 2022 and out. It's called the dot plot if you follow Fed speak. So we did our own internal dot plot this week just for fun because everyone was kind of arguing about inflation and where we think inflation is going to be. So we all kind of put through our view on where inflation is going to be. We did our own Rand Swiss dot plot. Now, the view from our house certainly is that yes, we are going through a spike now. The spike might get a little bit deeper, so you might see inflation coming off, but you will see inflation moderating towards about between 2.3 and 2.6% is kind of where we see inflation out, probably a year and a half to 2 years. And then we see it kind of running at that level, which is slightly higher than the long run average. So we think that inflation is going to be elevated. We think that the Fed and just the monetary policy response that the markets have made in conjunction with the fiscal response of these big stimulus packages coming out from Biden is going to leave inflation, economies are going to be at a higher risk of inflation. In general, our view is that the inflation is going to run at a slightly higher long-term average than usual, but because we have inflation targeting frameworks in place, the idea of getting back to an inflation rate of 20% that we saw, a couple of decades ago is unlikely because back then there was no inflation targeting framework. That said, we've got also, Viv's kind of got a long run, speculative one saying that 10, 15 years out, we could see inflation getting really, really hairy. Because obviously there's that natural view that, when nothing goes wrong for a long time, when we don't have kind of, an inflation problem for a long time, the mandate of these central banks goes more towards growth and employment and less away from and less towards price stability. And as the pressures, mount on monetary policy officials, the people that control monetary policy to allow interest rates to remain lower for longer, to allow kind of stimulus to stay in the economy longer. Eventually, Viv's of the opinion that we're going to overshoot. Kind of the base case is that we're going to run at a higher long-term average, but we think that for now, the officials kind of probably have things under control. So that's kind of our house view on interest rates and inflation. Okay, onto the US markets. What's happening in the US markets? So we had so as you know, from the last couple of months, we were heavily buying into, well, not heavily, but we were picking up energy and banking stocks over the pandemic. When we saw that quick run up in the tech stocks, we said, listen, there's really good quality value companies here that are probably going to benefit from the lower rates as well. So we picked up Citigroup, we picked up some additional ExxonMobil stock. We've sold out of that now. That was quite a short-term position for us. As you can see, we've actually only closed 13 positions since we started the portfolio 5 years ago. But we've kind of moderated that now, and we were of the view that with the oil prices rising as they have, and we're going to talk about oil in a bit, we thought that was a little bit too much of a move, and it's kind of played out perfectly for us this month. So, the last couple of months has been a little bit like touch and go with our benchmark. This month was a great month for the portfolio. We have energy kind of moderating. We've obviously got the OPEC announcements, which I'll chat about in a bit. And we've got, if you look down on the left-hand side, JP Morgan, Bank of America, Citigroup, all in the red. All the rest of our industry is doing really well. We've got Microsoft up over 10%, Google, Amazon, we own both those companies, recovering strongly. Starbucks up 5%, we've got that. We're going to talk about Nike as one of the stocks today. That up almost 20% over the last month, looking really, really good. And the rest of the market kind of quite green. So we kind of well positioned this month, but it's definitely big tech coming back in a strong way. Some of those consumer stocks as well. We've obviously got fees, so we've actually had a great month on the portfolio. But also some of the tech. The semiconductors makers obviously got that big semiconductor shortage. They're doing really well as well. So portfolio looking good, but that's the general US market picture. What's happening with coronavirus? We're all in lockdown. I shouldn't probably be in the office today, but like I said, we're closing a structure, so I don't have a choice. Unfortunately, for clients and for everyone, anyone, that works in our industry was always considered an essential worker. So we get to come to work even when there's level 4. We were even working in the office at a level 5 lockdown, but we do try and spread the risk as much as possible. So the guys that can work from home do work from home. But as you can see, South Africa, we're well into our third wave now. It does look like the virus numbers are coming down. So, hopefully things moderate a little bit in South Africa. I've got a point on that in a second, so I'm not going to talk too much about South Africa. US, 4th of July, that was when Biden wanted his 70% of Americans vaccinated, and it was going to be the new Independence Day. He didn't make it. He made about 50%, which is still a hell of a good effort in my opinion. And yeah, he didn't quite make the target. What I'd say, like, you aim up there, and even if you finish there, you still did a lot better than people that aimed a lot lower. So the US vaccination's going well. Like, their coronavirus cases look largely under control. Interestingly, we've got the UK at the moment. So the UK is scaling back on lockdown restrictions, even in the face of a rising pandemic. They've got a high vaccination rate, but they're still seeing cases starting to increase. Obviously, there are real concerns around what the Delta variant means for economies, and it's kind of like we were chatting about last month. I think what we've got coronavirus, as much as the markets, I still believe that the markets have coronavirus in its rearview mirror. I think we've learned a lot about how to live under, almost pandemic conditions. Even while our cases are worse in South Africa than they were in the first wave by a long way, our economy, I don't think, is going to be as impacted as the first wave, because we're not locking down to the extent where we can't buy chickens from Woolies and can't buy crop bottoms and stuff like that. So we've learned a lot about how the pandemic operates. Feel very sorry for the restaurateurs, but at least there's still takeaways. We've learned from the mistakes, and I think we're going to learn more as the pandemic continues. And I think humans are very adaptable. So our opinion at the moment is that we're obviously not virologists, but this pandemic is probably going to be with us for a long, long time. There's going to be different variants, and the variants are going to keep on mutating. And our vaccine, we're going to all have to go and be vaccinated, but we're going to get through this, and our businesses are going to reopen, and the world will be different to how it was before the pandemic. But it will carry on, and stocks will keep doing well, and companies will sell products, and people will live a slightly different type of life, but they will live a life. So we're still quite optimistic on markets. We have seen that this was one of the Fed officials, Mary Daly, from the San Francisco Fed, coming out and said, I think one of the biggest risks to global growth going forward is that we're prematurely declare victory on COVID. Now, I think I'm a bit guilty of declaring premature victory, because in past meetings I've said, we think it's in the rearview mirror. We think, markets are looking through this, and that from a investment point of view, you should be long stocks. We don't think that there's going to be another collapse based on COVID. I think that's still our view. I read that from the Fed and I say, yes, maybe from an economic point of view, there's going to be sectors of the economy that are hard hit, hospitality and restaurants, of course, but maybe air travel. But again, with the vaccine rollout and with us being able to adapt, I think we have the ability to look through it. What I read when I hear that the Fed is concerned about a premature victory, I hear that stimulus is going to be here for a little bit longer, which is going to be supportive of financial markets. It means that taper is not going to come, as I was kind of hoping, anytime soon. So I think maybe stocks are a little bit more buoyant as well. The big worry cases as well. India's kind of monstrous wave has subsided significantly. We still used to look at Israel because of their vaccination rate. That's a little bit less relevant now. Like I said, UK starting to go up. Globally, still cases are still elevated, but we're making progress on the vaccines. Currently, we've had 3.3 billion doses administered. Last month when we chatted, we only had 2 billion. So we vaccinated, well, we've at least put through another 1.3 billion doses over the last month. We have about 185 million active cases globally. This is up from last month. And we've got about 25% of the world's population has received at least one dose of the vaccine. And we have about 12% of the population is fully vaccinated, which is double what we did last month. So we are vaccinating. And I kind of feel like that should be fairly optimistic for markets as well. So that's the coronavirus. How are markets feeling? Okay, like I said, we had, with the FOMC minutes, we've had a little bit of nerves creeping into the market, and with the Delta variant, people are getting a little bit concerned. So I just wanted to put up we normally have a look at the chart of the VIX as well. So this is the volatility index. It's called the fear and greed index. It basically tells us, how is the market feeling? Middle of the pandemic, the best time to buy stocks was when the thing was at its absolute peak. If that thing is above 80, you buy shares. That's where you buy shares big time, because that's where everyone is so scared. That's where everyone else is selling, and you've got to take kind of that contrarian view. We've seen the pandemic moderate, at least the kind of the sentiment in the market moderate. As volatility has kind of decreased. We were hovering at about 20 for a long time, which is higher than on average. But before that, I mean, going into the pandemic, we got the spikes up to kind of 35 every now and again. But on average, the VIX used to sit between kind of like 10 and 15 was really the kind of level the VIX used to sit at. We've just, like I said, we've just had this little spike up now as the Delta variant gets a little bit more out of control, as the Fed indicated that it might taper. People are just a little bit concerned, and you're getting the sense there's a little bit more fear in the market, and there's been a little bit of selling in the market, which is why the VIX has been ticking up. If we get up to kind of like, I think for short-term entries on portfolios, if we get above 25 to 30, we're going to start really putting our foot down on implementing portfolios. Are we going to wait for it to get back to 80 before we buy? Absolutely not. That's kind of a once in a 10-year event. Normally, it can obviously happen whenever. Black swans happen all the time. But is it going to be because of the coronavirus? Probably not. It's going to be one of those unknown unknowns. So for us, VIX above 25, markets down 5-10%, that's when we're going to be pulling the trigger and putting clients in. That's the VIX. Okay, so what else happened this month? So let's have a look. I'm going to quickly go through. I'm going to run out of time today, but quickly go through Nike's numbers. Sorry, so I'll move this so I can see them as well. Okay, Nike. So Nike is one of the stocks in our portfolio. As I said, it's had an absolutely spectacular run, but we'll look at that in a second. What happened? Why is Nike running? Why are we looking at Nike today as like kind of the preferred stock? Call it a stock pick for today. It's a weird stock pick because it's actually, I'm going to say, don't buy it today. You should have bought it on the 21st when we were buying, when we were topping up all the clients ahead of earnings. But we basically have more information coming out of Nike, so we can go and have a look at their earnings. Basically, record revenue in the US. They doubled their sales. Now, all the numbers in these companies coming out of the pandemic are a little bit skewed because, you've kind of got coming out of lockdowns, and you can see it in Nike's earnings numbers on the bottom left. They kind of, each of those are divided 2017, the 4 quarters, 2018, 4 quarters, kind of going through the years. Fourth quarter of 2020, earnings collapsed in Nike. I mean, we had negative earnings. It's since recovered, and we're looking strong in 2021. These were the fourth quarter earnings, so we're going into Nike's new financial year next reporting period. But earnings have recovered. Earnings have been pretty robust through the pandemic. Revenue is also kind of ticking up nicely. So earnings per share, 93 cents per share versus the expectation of 51, smashed analyst estimates. Revenue also, I think they were expecting a much tougher time again because of worries in China. Revenue came out at 12.34 billion for the quarter versus 11.01 billion that was expected. Record, like I said, record revenue in North America. The other thing that they came out with, the Nike executives came out with a much, much better sales outlook, which is also just saying that they think things are going to stay strong for a while. Jordan brand, not brand, but the Jordan brand is also flying. Jordan doing very, very well for them. And also, interestingly, their kind of wholesaling is doing much better. So through Dick's Sporting Goods, Foot Locker, JD Sports, they're managing to sell through more very selected partners. Remember that Nike works with partners, but very specific partners. And I've kind of used them often in an example when we talk about platform businesses and in the entertainment space. They've pulled their products off Amazon. They don't want anyone other than people that they have direct control of selling. And for us, what is key to this is really their brand. They have, as I said, they've got some worries in China, which everyone is kind of concerned about. But remember, they also have a 40-year history in China, and it kind of goes back to my point around China earlier. I don't think it's smart for any investor, certainly not a global investor, just to stick their head in the sand and say, China doesn't exist, I'm only going to invest elsewhere. It's a good diversifying factor. Yes, it's slightly more risky, but there's huge opportunities in China as well. They've got 40-year history working in China, and it's still one of their fastest growing markets. I'm not too concerned. As you can see, it makes up about 20% of their revenue on the 2020 numbers. But the bulk of their revenue is still coming from the US. But Nike is a truly global business. I mean, it's a well-diversified company geographically. It kind of is perfect for putting in a global equity portfolio. It operates everywhere. We buy Nike in South Africa. I mean, everyone understands the brand. Why is the brand key? Why is a brand important in general? Why would you want to buy a company that has a strong brand? Because if you've got a strong brand, you are communicating trust to clients. It comes down to, there's a whole argument around the asymmetry of information around a brand, but because people know it and because their marketing team is so strong, and because when you've got a brand, you're able to sell things to people that far in excess of what their underlying intrinsic value is. It's one of the kind of fundamentals of entrepreneurship. If you've got a product that everyone else thinks is worth X, but is actually worth much, much less to manufacture and to create, the difference is the brand value. And that brand is, and that kind of belief is what allows you to make really super normal profits. Nike brand, like everyone knows the swoosh. It's incredibly powerful. It also allows them to pull themselves off a platform like Amazon, because if everyone knows what Nikes are and they all trust Nike brand, and you know what you're getting when you buy a pair of Nike shoes, and you don't need to go on Amazon and search and look at the little rating system, say, oh, these shoes have 5 stars. You trust the brand. And because you trust the brand, you'll go on Nike's website and allow Nike to deliver them to you directly. An unknown new shoe brand just doesn't have anything like that. That brand is the competitive advantage for Nike, in my opinion. On top of the kind of fundamental benefit of being able to make shoes for $2 and sell them for $50, $60, there's obviously a tailwind behind the stock as well, just because I think that developed market consumers are in a better position. So there are some macro tailwinds to the stock as well. Now, I thought, if we're looking at this, let me show you some of the ways that we think about companies. So this is, okay, so we've got a target price of $181 on the stock. It represents about a 13% upside from here. We are comfortable that even here, we would be willing to buy Nike for a client. I probably wouldn't, just based on technicals, but longer term, it should be in your portfolio. Why would we put the company on a buy? We put the company on a buy because on average, the S&P 500 does around 8.5%. We are trying to outperform a benchmark. So if we believe the stock is going to do 13% over the next year, which is what we think, that's a 1-year price target, we would put the stock in a portfolio. Like I said, we've just had the thing. So based on technicals, Nike was in this kind of sideways channel. Fortunately, we were picking up for clients. If you've got a portfolio and you didn't have Nike in it yet, I filled every client in our company with Nike on the 21st, which was great. So the 21st was just before that spike. So you would have seen you're all up about 20 to 30% on Nike from there. But yeah, like it was a little bit more aggressive price target. Now, obviously, with the spike, I would probably say if you don't have Nike, but you want to enter, like I said, I probably wouldn't buy it right now today. But I'd probably try and enter on the top of that kind of green little trend line, the top of the green horizontal channel. If we get a pullback to that kind of break level, so I would say buying at about 100, anything just above $145 a share, that's the place to buy Nike. What's happening in the community? So this is the sell side community that you're seeing on the right hand side. Obviously, they've had quite a stable price target for the last little bit. But as you can see that, as you see the kind of the more and more green, that's just more and more buy ranking by analysts from institutions ranking it as a buy. Why do we look at this? When an analyst ranks it as a buy at a Goldman Sachs or a Merrill Lynch or a Credit Suisse, it means that their portfolio managers are then allowed to buy the stock for their clients. It represents the decisions being made at large institutions on large pools of money. When you see something going from, say, 5 holds and 2 sells, for at least 7 holds and 2 sells, down to 3 holds and 1 sell, that kind of tells you that there's some institutional momentum behind the stock. People are getting excited about the stock. That's just kind of getting a sense of what's going on in sentiment. Then we've also got kind of our general models as well. So earnings, fundamental, relative valuation, risk, price momentum, insider trading. These are all models on how we rank the stock. I haven't ever shown you guys this stuff before, but it's one of the things that we look at when we consider portfolio inclusions. Earnings, at the moment, 10 out of 10 on earnings. 10 is the upper level. Fundamental comes out at a 7. Relative valuation is a 2 at the moment, which is kind of, we'll go through the details of that, but also you can understand there's just been a spike up in the stock. That's why the relative valuation a little bit higher. Price momentum, very, very strong. Price is going up, so buy it. That's kind of the momentum thing. Risk looks at their debt and a couple of other factors. Their risk is also ranks very, very well at about an 8. And insider trading is kind of what the insiders are doing on the company, which is, we kind of pay less attention to that overall. So here's how we break down the risk indicators. I'm going to run out of time, so I'm going to go through these super quick. But yeah, this is kind of our fundamental indicators, and we kind of rank these against all sorts of other people. So there's profitability gets a 25% rank, debt gets a 25% rank, earnings quality 25, dividend 25. Now, you can kind of see that ranked against a whole lot of other companies. So Shoe is Steve Madden, SKX, that's Skechers, Deck is Decker Outdoor, Crocs is Crocs. I cannot believe it. I was looking at Crocs the other day. Crocs are the most hideous shoes in the whole world. I don't know why people love them so much. Yet Crocs is up almost 800% over, I think it's the last 5 years. So Crocs has just rocketed. Way better than Nike. So Crocs would have been the better pick, but we prefer Nike because it's kind of a little bit more stable than Crocs. And you can see, yeah, so that's kind of a relative. Risk is basically looking at just like the volatility in the stock. Everyone, I'm going to talk about this hopefully at the end of the presentation. Everyone focuses on performance and they forget about risk as well. Risk is very, very important. What is it doing in terms of the volatility compared to the benchmark that you're tracking? What is its correlation to other stocks in its portfolio? What is the volatility on the share? I was getting trolled by someone on Bitcoin, like, Gary, well, you might have done 110% in 5 years in dollars on your portfolio, but if you had bought Bitcoin, you'd have 100 bajillion percent and you're an idiot, basically. And I said, but yeah, you're not comparing apples and apples here. You're comparing something that has a very low risk profile, and you're only looking at performance, which is the biggest mistake that retail clients make. It's the biggest mistake that people make. They look at the performance metrics of something, and they don't think about what risk they accepted in order to create that value. So the idea of risk-weighted returns is incredibly important to us. So those are some of the risk metrics that we have a look at. And then, of course, we've got relative valuation. So we're looking at the PEs, forward PEs, PEGs, all of that. And you can kind of see where Nike's sitting. Nike relative valuation is not too bad compared to the rest of the stocks in the industry. Skechers on the forward PE is just hellishly up. And then relative strength, price momentum is more of a technical indicator. But yeah, so that's kind of just giving you an idea of what we kind of think about when we're picking stocks. Yeah, commodities. Okay, so commodities, I'm going to run through also super quick. Okay, Bloomberg Commodity Index, we've seen a moderation in the commodities over the last couple of months. So we saw it in May. That's when May we actually sort of saw commodities coming down. It's still volatile. And over June, you haven't seen a big absolute move. It did make kind of a new high on the Bloomberg Commodity Index, TRCCRB is basically the Reuters commodity index versus the Bloomberg one. They're obviously very, very similar. I thought just give you 2 for a change. So commodities kind of moderating. Oil, I'm going to talk about oil specifically, but that's all the oil, the different types of oil from Brent crude to West Texas and all of that kind of mixed together. Oil price is still very, very elevated, but I'm going to talk about that in the next slide. Okay, over here, we've got the kind of softs and the grains. So soft commodities, best performing is Robusta coffee. So coffee doing exceptionally well. We own Starbucks, and weirdly, the price of coffee makes no difference to Starbucks, just out of interest, because they hedge all of their coffee production. Cocoa is collapsing, but what we're seeing here is this idea of like what is going to create the inflation. We're seeing some sort of normalization in the commodity markets. If you look at grains, corn up 31% for the year, wheat down around 6%. So also even in commodity prices, you've seen quite a bit of I suppose, diverse price performance. So this isn't anymore a case of just everything is getting way more expensive. We've seen quite a nice moderation of a lot of things. So kind of view, we'll look at something like, okay, so weirdly, the Paris rapeseed, massively spiked up, kind of moderated down now. Everything kind of getting back to a little bit more normal, and why we think inflation is going to become slightly more controlled. Got your metals down here, silver, platinum, and gold. That hasn't been a great year for the kind of precious metal commodities. That had a really running up year in 2020 when everyone was panicking, under a little bit more pressure. Everyone's got their own view on that, probably talk about it in a different session. And then down on the bottom right, we've got, like I said, we've talked about the softs. Cocoa under pressure, sugar kind of moderating as well. So that's kind of your dashboard of what's happening with commodity prices over the last little bit. So let's quickly have a look at what's happening in oil. So I kind of picked oil as the commodity that we should have a look at in a little bit more detail today. OPEC is causing all sorts of problems. We have no OPEC agreement. So OPEC meeting came together, and remember, OPEC has put in place supply curbs. They said, listen, with coronavirus, with everyone locking down globally, we're just pumping too much oil. You'll remember that we almost hit what's called tank tops, where everyone was just full of oil. You couldn't put oil. People were pouring oil into their swimming pool. You couldn't hold oil anymore. There was just nowhere to put it. Tankers were piling up in harbors because we had produced too much oil. So OPEC put in supply curbs. We now are limiting the amount of production that can be created in order to try and get the prices up a little bit. That's what OPEC's plan is anyway. Now, you've got certain members of OPEC, specifically the UAE, who want to pump more oil, and they haven't managed to come to an agreement. Now, OPEC is a weird cartel, a very weird cartel, because OPEC, most cartels collapse. There's been attempts at cartel, like a cartel it's a structure in economics, like you have, perfect competition. Cartel is like an oligopoly. It's not quite a monopoly. It doesn't have the whole industry, but it's a number of independent players that control the market. Now, it's a notoriously unstable economic structure because there's always the incentive for one person to cheat. It's kind of the whole idea behind game theory and the prisoner's dilemma. And in oil, it makes perfect sense. If you're part of OPEC and we all agree to supply curbs, the price naturally goes up because they control the market. But if you cheat, you get to pump more oil and you get to get the higher price as well because everyone else has curtailed their production. So you are incentivized to cheat. Now, that's why it becomes an unstable structure in economics. Now, what happens is, Russia cheats all the time. They're the plus. But generally what happens is cartels collapse. Tin cartels have collapsed. Coffee cartels have collapsed in history. It's very difficult to maintain it. But the OPEC cartel is probably one of the longest running cartels in modern memory. Now, why does the OPEC cartel work? The OPEC cartel works because Saudi Arabia is such an important member of it. Saudi Arabia is almost a monopoly within the cartel. So when someone misbehaves in the cartel structure, Saudi Arabia can just curtail. They in the past have just kind of almost absorbed that and said, cool, we'll just keep dropping production so that we can continue to manipulate the price. So that's why the OPEC cartel has worked, but things are changing. Remember the idea that we are super reliant on oil is changing. The idea that you want oil at $144 a barrel because you can get away with it is changing. When you get a good in economic like oil that increases too much in price, suddenly substitute goods become more attractive. In this case, if oil goes too high, it accelerates the advance of electric vehicles. If oil was $10,000 a barrel, we wouldn't drive cars that use oil. Everyone would have electric vehicles almost instantly because it would be such a crisis that we would have to move. So Saudi Arabia, or at least the OPEC cartel, is trying to balance this idea that they want higher oil prices. They can't get too high, because America can still come into the market aggressively through shale, although that's more difficult now that Biden's in charge. But they also don't want a quick move to electric vehicles because it makes the oil less relevant. So they kind of trying to moderate it. At the same time, now what happens is there going to be an OPEC agreement? Isn't there going to be an OPEC agreement? They still have no OPEC agreement because the UAE saying that they want to pump oil. Everyone's saying they want to kind of continue to constrict oil. Now, there's two kind of different schools of thought as to what's going to happen here. If there's no agreement, technically what should happen is no one's going to increase their supply curve. So everyone must adhere to the old agreement, which means that oil doesn't get pumped, which means CNN's headline, oil prices surge after all OPEC calls off talks. That's kind of the face value of it. I think you need to look a little bit deeper into the oil markets as well. And I kind of said this before, this is the Business Day headline for today. Oil is now falling again. If there's no agreement on this, yes, technically every OPEC member should pump at the exact same level that they were pumping previously. The problem comes that there's an incentive to cheat. If oil prices are still high and you're the UAE, you have every incentive to go, well, I don't agree with OPEC, so I'm just going to release more. Russia always cheats. As I said, they hardly ever stick to their production quotas. So there's another school of thought that says if OPEC can't come to an agreement, there's a chance that everyone starts just pumping free for all. And if that's the case, you're going to see oil prices moderating and coming down quite significantly. Our house view is, I mean, this is a market that has incredibly a lot of moving parts. Like I said, the US can always come in, and the US rig counts have been increasing. Is that going to continue under Biden? Difficult to say. You've got an Iranian nuclear deal that's going through with the US at the moment as well. If sanctions against Iran get dropped, Iran will come into the market with a huge sort of like glut of supply will come onto the market through Iran. That could potentially moderate oil prices as well. But at the moment, what's happening is we're seeing crude oil inventories falling. So at the moment, we've got what's called US driving season. It's kind of a heavier energy usage period for the Northern Hemisphere. And what happens is, we're basically seeing oil being used and not enough being supplied. And that's why you got the price going up a little bit. Kind of our house view at the moment is that, there is a risk that oil could go back to $144 barrel. It's a risk. It's possible. I probably wouldn't even be shorting oil at this stage. But we do, I personally think that oil is going to moderate around the $70 to $90 a barrel level. I can't see it, short of like a real supply shock. I don't see it getting to like $120 a barrel. And that's one of the reasons that we were kind of very keen to go into energy companies like ExxonMobil when it was, when you $20 a barrel, it had to go up. There was no question. At $70 a barrel, it's less certain that it'll keep rising, in my opinion. So that's kind of how we're thinking about the oil markets at the moment. Currency markets, well, I'm going to go way over to them today. Sorry, guys. Okay, the Rand. What is happening with the Rand at the moment? So I've got a thesis. Here's the stuff. I mean, we're going to publish this afterwards. I've put this chart on Twitter as well. We are in this long-term downtrend that you can see, and that's since the spike up over COVID. Everyone panics. They pull money out of emerging markets. Everyone heads for safe havens like the dollar and the yen and the Swiss franc. And what happens is you see this kind of the spike out, and the dollar gets really strong and the rand got really weak. We've all kind of experienced the stronger rand now, so the rand's been getting a lot firmer. And I think when it got down to 13.40, that was where I couldn't understand it. I said just before that I think 14 is a great level to go and buy dollars. What we've got now is we've got this little break on the technicals of that long-term downtrend. You've also got the rand trying to break above 1440 to get back into this old horizontal channel. I think if you get a solid break of 1440, you're going to be heading up to 1550 quite quickly. Obviously, the other thing is currency can do anything. It might be coming down. If it does come down, I mean, I would assume it will go and test 1340 and probably set up a new horizontal channel down there. It is slightly overbought on the RSI at the moment just because of the big weakening that we've seen over the last little bit. 1340 would have been a great level to take money out. Don't feel bad if you didn't. Very few people do. I've got another picture which I'll share on Twitter at some point. But we feel it. The currency starts to weaken and it goes from 14 to 15 to 16. If the currency moves to 16 today, at 16 our phones will be ringing off the hook to take money out of the country. We beg you guys, we send out notes to you saying, please take money out at 1360, 1370. Christo did a special currency alert for you guys at that level. No one's interested in moving currency. And unfortunately, it's just the function of how markets work. When it's really strong, everyone thinks it's going to get stronger. When it's really weak, everyone thinks it's going to get weaker. It's just how it works. But yeah, our kind of sense at the moment is we're going to get a little bit weaker. All the local banks, so ABSA, Nedbank, and Investec, they've all moderated their targets weaker. Investec's gone to 1530 on a one-year view from 1460. Nedbank has gone to 1484 from 1436. ABSA to 1415 from 1410. So not much move there, but still weaker. SocGen has come out with a call. I'm going to be shocked if we get there, but that SocGen, like their kind of 1, 6, and 1 month, 6 month, and 1 year view is basically just the rand getting stronger in a straight line. They think the rand is going to 1220. So they might be very right. Goldman Sachs has also gotten much more bullish on the local currency. 1380 down to 1280 is their new 12-month target. And I mean, in a way, we're feeling this as well. So I'm not going to totally disagree with them because, the South African markets are looking good. They're looking really good. And part of this is, I mean, we're feeling from kind of, so we've got international clients as well, and they keep telling us, like, South Africa is great. Why are you guys so worried about South Africa? And you're definitely getting it. Like, I mean, obviously we had the announcements that Imperial has got an offer from DP World, so Dubai Ports World, to buy it and delist it. Heineken has got an offer out to buy the whole of Distel. We had Clover a little while ago. We've got Adapt IT is probably going to be taken off our local market. Big smart money. Other companies are looking at the South African environment and they're saying, hey, you guys are not pricing these local stocks correctly, and they are coming and just buying up the whole issued share capital. So I do think South Africa is cheap, and I think we may be a little bit too pessimistic about South Africa currently, especially our small and mid-cap space. But that said, pandemic, big problem. And I'm going to show you why in a second. So this is why I'm concerned about the currency. And it's not that I think South Africa is crap and I don't think that we can make a go of it and our companies are all going to collapse. I think that if you look at like our macroeconomic environment at the moment, the countries that we compete for capital are starting to increase their interest rates currently. You look at what's happening so I've given you Russia. So I've given you some of the BRICS countries and then also Mexico. So Russia, you can see inflation increasing like the US, like South Africa. But what they've done is they've started their tightening cycle. They've actually started to increase interest rates to counter the higher inflation. Brazil, the same. Brazil, inflation starting to get a little bit out of control. Not out of control, but a lot higher. Interest rates starting to increase in Brazil. What's happening in Mexico? Same thing. Mexico also makes it a little bit more volatile on interest rates, but they've made their central bank has made its first move to tighten interest rates. What has South Africa done? We just can't. Lesotho Kanyako, I think this month won the best central banker. I think best central banker in the world. We got it honored. He's a great guy. I've met him. He's honestly like. Our Reserve Bank is one of the institutions that South Africans are going to be incredibly proud of. At the same time, I do think that their hands are tied. We are going through an incredibly difficult pandemic. Our private sector and our businesses are under so much pressure at the moment. It's very difficult to see that they are able to raise interest rates. I think they're going to have to, because you can see what's happening to our inflation. Our inflation, I still think it's going to be transitory, but our inflation is increasing, and with our emerging market peers starting to increase interest rates, we are going to have to increase interest rates. Maybe that's going to take the shine off some of our local stocks. It's going to make business a little bit more difficult in South Africa. Maybe maybe they're going to hold interest rates flat for a little bit longer, but the next move is definitely going to be higher. We talked last month about our PMC accounts, which is the prime money call accounts. If you're still sitting in a CCM account, you need in a money fund account. I suggest you move to the Prime Money Call account. It's going to boost as interest rates adjust. You're going to get a better return faster than on the money fund account. You're going to probably get a percent or two better in that account. It's free to switch. Just come and talk to us afterwards about the PMC account if you haven't done it yet. Okay, global managed portfolio over time, but let me quickly run through this as well. Okay, so like I said, like a little bit of a celebration going on here if we weren't closing a structure today, but 5-year track record is now up on our managed portfolio, on our global managed portfolio, which was the first and pretty much only portfolio that I run. We have returned 110% in dollars over the period. So this is just a screenshot of the system. Rand Swiss is down here, so it's 110%. So we've done 110% in dollars. So if you, this is again rebased to like you're taking South Africa and you're rebasing it to dollars as well. So South Africa over the same period, if you had invested in the local market, you've only done 28%. We've done more than 3 times the South African. We're getting towards almost 4 times the South African index in dollars over the last 5 years. We've more than doubled your money in dollars if you had invested 5 years ago. I've got all the performance stats down there. So first year, very, very difficult. I mean, we were just implementing. You can see this is our cash weighting. We're slowly deploying the cash over the first couple of months. We only did 2% in the first year. Then we did almost 22% the year afterwards. This year, this was like this little dip over here, that little dip over there. In 2018. That's why we ended, you can see it was a horrible December. December, just basically the market collapsed 10%. We went down 8.2. Market went down a lot more. We still outperformed all the other benchmarks, but we ended 3.6% down. It hooked around in January almost immediately. And all that additional performance was kind of felt in the next year where we did 29 because we were coming off such a low base. So we did almost 30% in dollars the year after that. Last year through the pandemic, we did 18.3%. We're up 14.1% in US dollars year to date. That's what the portfolio is looking at. We basically run this as a personal share portfolio. So we put 100,000. Okay, so we actually, the first stock we executed was Google on the 29th of June. So we actually executed 2 days before July. So we kind of crossed the mark on July. So this actually runs from the end of June. So we had already bought a share at that stage, which had kind of given us a bit of performance. But we basically put just over $100,000 into an account. In that account at the moment is sitting $210,000. That's what we've done. That's real performance screenshotted off a system for you. And then what we do with clients is obviously we set up your own PSPs. You guys track exactly on what we do. We manage your portfolios in a personal share portfolio structure. Remember, we're stockbrokers. We're not putting you in a fund or anything like that. There's benefits to this from a tax point of view because when we sell stock, we release a little bit of CGT all the way through. So we're constantly getting your CGT base higher. You get to use your 40,000 Rand exemption then. So from a tax point of view, depending how you manage it, it can be more efficient than sitting in a pension fund. Not a pension fund, at least in a unit trust wrapper. It depends on what you're doing and how we're doing it. The way that we manage for tax as well. Global equity portfolio, we have accelerated our outperformance. So that's just basically a duplicate of this chart up on the left-hand side, except benchmarked against the MSCI World Index, which we've also outperformed. That's our benchmark. We don't benchmark against the top 40. Obviously, it's an international portfolio. We benchmark against an international benchmark. Our relative outperformance, like I said, we've had kind of steady outperformance. We really just killed it because like through the pandemic, we didn't come down nearly as aggressively as the market because, again, it comes down to risk, and I'm going to show you a risk metric in a second, but we're managing at a lower risk than the market. This pops up and we've got, you can see like that kind of trend of outperformance is continuing. We had a little bit of a wobble afterwards because we went to cash. We did a little bit of reweighting. We were buying and selling things, which kind of generates a little bit of frictional cost in the portfolio as well. All these stats are after costs. We've taken our fees, everything is done, but we kind of, that kind of pulled back our performance. We also sat a little bit too heavy in cash, as you can see here. We let our cash weighting get quite high. We're still sitting on quite a bit of cash. Like I said, that's why I'm hoping we get a little bit of a panic so that we can buy in and deploy the rest. We've got all our companies ready. We're just waiting for target prices, and we're deploying 2 new portfolios. But yes, going up, everything good. Yeah, like I said, we had a killer month this month. So this is just a month-on-month chart of how we perform versus the benchmark. I mean, we smashed MSCI World last year after a little bit of difficulty, but generally we're a little bit ahead. That's our benchmark. So we've done 110%, and I've just benchmarked against a whole lot of different things just for fun. MSCI World's up 105%, we're up 110. We beat the S&P 500 up 106. Like I said, we destroyed the South African market. We've also done a lot better than the emerging markets, which are only up 87%. Over the last month, we're up 3.24% versus the MSCI World, which was only up 1.49%. Like I said, we just got our sectors right this time around. So things are looking good. Interestingly, we might actually shift the benchmark in time to come, because you can see this is the country weight of the MSCI World. Currently, we're sitting at 67% of the MSCI World index is US based at the moment, which is like typically not a global portfolio. And as we're moving towards like now launching our European and our UK versions of this, the idea would be that this might become more of a US portfolio, but more on that in future. Doesn't change the strategy, doesn't change the way that we generate our alpha and our performance. So this is what I'm talking about, the risk-weighted, and taking into account, like anyone can go and look at performance and go, hey, Gary, well done, high five, you doubled your money in 5 years in dollars. Or they can say, you're an idiot, why didn't you buy Bitcoin? Bitcoin went up a billion%. Like, that was clearly a better buy. Yes, in hindsight, but the point is Bitcoin is incredibly volatile. You've got to look at the risk in the portfolio as well as the return. So this is a nice thing. So this is just a 3-year scatter. So this is our performance versus our MSCI World benchmark. And you can kind of see that the MSCI World, so this basically accounts for, you've got the performance on the up chart. So the higher the square is up the chart, that's the more performance there is. And the more the square is to the right, the more volatile the portfolio is. So this is one of the wealth tools that Yaku uses, and it's really awesome because kind of when they build a whole fund strategy for a client, we'll only be part of it. Like the managed portfolio might be 10 or 15 or 20% of your overall strategy, but you'll have bond funds and all over the place, and you'll have many different, you have a little bit of commodities, you'll have all the things that a wealth manager looks at, and we'll only be one component of that overall strategy. When he puts all of that in, I can tell you our volatility is lower than equity portfolios and our performance is higher. We're generating real value with this portfolio. And you can see the performance F1 is the Rand Swiss Global Equity portfolio. The performance is, as I said, is high, but the volatility is low. It's both above and to the left of the triangle, which is the MSCI World portfolio, which means that we're getting better performance in the MSCI World at a lower volatility too. So it's both the risk and the performance are better than the MSCI World, which I'm really happy with that. What's our philosophy? I've kind of taken you through it. We buy whatever we like, but we tend to stick to big blue chip companies overseas. This is not a super speculative portfolio. Most of our clients are using this portfolio to generate returns long term. It's their nest egg. They've taken money out of the country. This is done with fully externalized funds. They want to park this in and get good growth on their funds over the long time. This is not money they're going to access in the next 5 years. This is their nest egg emergency basket of stuff that grows long term. That's what we're trying to optimize for. We've got big multinational companies in there as a result. We're not buying super speculative stuff. I mean, we discuss it with our private clients. I mean, Werner's got this new one. He's got it's basically a pharmaceutical pet food company. It sounds fantastic, and it's going to do. I'm sure it's going to do very well, but it's not appropriate for this portfolio. This portfolio is specifically big global blue chip kind of companies. So that's the philosophy. I am the ultimate portfolio manager. Like I said, we do investment committees once a week just to kind of make sure that everything is good. We charge 1% for it. Obviously, like I said, all those performance stats are after the 1% has already been applied. So like we've definitely earned it because we're doing better than the benchmarks. And don't remember, index products, you still pay a fee. And I'm going to do a nice article with the Finance Ghost for next week around the secret costs of ETF spreads. So yeah, it's obviously actively managed, but that's kind of what we do. And yeah, if you're interested, give me a shout. We manage at Swissquote, Standard Bank, at least Swissquote, Saxo Bank, and Interactive Brokers. You have a direct sight of your portfolio. Currently, markets at about 1427 in terms of currency. Like I said, we've got our treasury desk that'll do the whole process for you. Once you've done an application with us, Christo and the guys will take you through the whole process. You literally are going to do a local EFT, and that's the end of the hassle from you. We take care of everything from there. We kind of stick the money into our local accounts, and then you forget about it, and we take care of everything else. It's very easy. We've deliberately picked up systems and that to make this as simple as you go online, you make an application, and we do an EFT. That's what we're trying to get to on onboarding process. Nice and simple. That's us. Go to account, send me a mail, phone us, do whatever you want, and we will, and I'm sure we can help. Cool. And that's me for today. Okay, we've got kind of a few questions. Oh no, I've answered the questions in the thing. Yeah, so I'm a little bit. I'm 15 minutes over time, so sorry for that. I'll make next month's one a little bit shorter, and then I won't have to speak so quickly either. But I hope you guys enjoyed it. If you got any other suggestions of things that you want to see changed, or if you don't find this useful and you say, Gary, rather talk about how CFDs work. If you've got any topics that you want us to cover, please get hold of us and just say, like, listen, can you cover this? Can you cover that? That's what we'd be really interested in hearing about. We've got tons of stuff up on the website, like our events page is really, really full at the moment. But if those are not the events that you are engaged with, those are not the events that excite you and they're not answering your questions as hopefully our clients, then we're failing. And we're only going to know that we're failing if you come and tell us. So please, if you're not happy with anything, come talk to us. We take it very, very well. We're stockbrokers. We have thick skins. But yeah, thank you for listening. I hope it was useful. And I will see you next month for this one, but I'm also doing next Wednesday, I'm doing a pharmaceutical kind of webinar. So we're kind of calling it Top Stocks. I'm going to go through 3 or 4 pharmaceutical companies. I'm going to pick the best pharmaceutical company and take you through why I believe it's a good company. It's kind of more linked to our private broking offering. But yeah, if you're interested in learning whether you should buy Johnson & Johnson or Pfizer or Roche or whatever pharmaceutical companies you decide, maybe I'll throw in Werner's pet food company as well. Come and listen on the 12 o'clock on Wednesday. You can go to the website to register. Cool. Thanks, everyone. I will see you later.